Let's have a quick chat about the stock market. You might have heard about it on the news or maybe from friends and family, but what actually is it? Don't worry, it's not as mysterious or complicated as it might seem at first glance. In fact, the basic idea is much simpler than most people think. The stock market is just a place where people come together to buy and sell pieces of companies. Imagine a lively, colorful marketplace, full of energy and excitement. But instead of trading fruits, cheese, or vegetables, people are exchanging tiny pieces of ownership in big companies. These pieces are called shares, or stocks. When you buy a share, you're not just holding a piece of paper or a digital number, you're actually becoming a part owner of that company, no matter how small your piece might be. It's like owning a tiny slice of a giant pizza and hoping the whole pizza gets bigger and tastier over time. As a part owner, you want the company to do well. If the company grows, makes more money, or becomes more popular, your share becomes more valuable. That's the main reason people buy stocks. They hope their piece of the company will be worth more in the future. If things go well and the company thrives, the value of your share can rise. You can then sell your share to someone else for a higher price than you paid, making a profit. This process of buying, holding, and selling shares for a potential gain is what we call investing. People invest in the stock market because over time, it has the potential to grow their savings much faster than simply keeping money in a piggy bank or under a mattress. It's a way to put your money to work, helping companies grow while you build your own wealth. The stock market itself is made up of many companies, big and small. For example, the S&P 500 is a group of 500 of the largest companies in the US, and it gives us a snapshot of how businesses are doing overall. When you hear about the stock market going up or down, it's usually referring to collections like this. But remember, the stock market doesn't always move in one direction. Sometimes unexpected events or bad news can cause values to drop quickly. This can be scary, but it's a normal part of how markets work. That's why the stock market is such a fascinating place. It's a mix of hope, excitement, and sometimes worry. People from all walks of life participate, each with their own dreams and goals, making it a truly dynamic and ever-changing world. The American stock market has been on a wild ride since early 2023, climbing like a rocket. The S&P 500 soared 24% in 2023 and another 23% in 2024. The best two-year run since the late 1990s. Even in 2025, it's still rising, up another 8%. This is what's called a bull market. Everyone's feeling confident, pouring in more money. But after such a steep climb, some experts are getting nervous. Historically, 3 years of huge gains in a row is rare. People wonder if prices are based on real company performance or just excitement. It's like building a tower out of biscuits. The higher it gets, the wobblier it feels. No one wants to miss out, but everyone's peering around the corner wondering if a drop is coming. After such a blockbuster run, the big question is, what happens next? Here's where things get really fascinating. Most of the stock market's recent gains haven't come from hundreds of companies working together, but from just a select few tech giants. These companies have become so influential, they've earned a nickname, the Magnificent Seven. It's a catchy title, but it also hints at just how much power is concentrated in their hands. Think about companies like Apple, Nvidia, Microsoft, Amazon, and Google. These aren't just household names, they're titans that have grown so large their ups and downs can sway the entire market. When these giants make a move, everyone else feels the ripple effects, from investors to everyday people with retirement accounts. In both 2023 and 2024, these 7 companies were responsible for more than half of the S&P 500's total gains. That's right, out of hundreds of companies, just 7 drove the majority of the growth. It's a staggering statistic that shows just how much the market leans on these tech leaders. Imagine a lineup of 500 companies, but only 7 are doing most of the heavy lifting. This phenomenon is called market concentration, and it means that the success or failure of a tiny group can have outsized effects on everyone else. Take Nvidia, for example. Fueled by the explosive growth of artificial intelligence, Nvidia's stock price skyrocketed an incredible 861% in just 2 years. That kind of meteoric rise is almost unheard of, and it's a big reason why the market as a whole has looked so strong. When a single company grows at such a breakneck pace, it can pull the entire market upward, even if most other companies are just inching along. It's like having one superstar on a team who scores all the points while the rest just try to keep up. But there's a catch. The market's health is now tied to this tiny, exclusive club of winners. If something goes wrong for even one or two of them, the impact could be felt far and wide, well beyond Wall Street. It's a bit like lining up dominoes. If the first few, representing these tech giants, start to wobble or fall, the rest of the market could quickly follow. The system becomes fragile, and everyone starts to worry about what might happen next. In a way, it's like a complex invention held together by a single straining piece of string. As long as that string holds, everything works. But if it snaps, the whole contraption could come tumbling down, reminding us just how much is riding on the success of a few powerful players. Let's talk about the so-called AI bubble. Everyone's betting big on artificial intelligence, convinced it'll change everything. This excitement has sent tech stock prices soaring, sometimes far beyond what the companies actually earn. A bubble forms when prices are driven by hype, not reality, like a giant balloon ready to pop. Nvidia, for instance, is valued at over 50 times its annual profits, compared to a healthy average of 18. Some experts say today's top tech stocks are even more overvalued than during the dot-com bubble. Back then, people poured money into anything with .com in its name, and when the bubble burst, fortunes vanished overnight. The fear is that history could repeat itself. AI's promise is huge, but are prices too inflated to last? If the bubble pops, a lot of investors could be left disappointed. There's another twist, passive investing, where funds automatically buy a bit of every company in an index like the S&P 500. This method of investing has revolutionized the way people think about growing their wealth. Instead of picking individual stocks, investors can simply buy into a fund that mirrors the performance of an entire index. This means they get a small piece of every company in that index, spreading their risk across many different businesses. It's become hugely popular because it's cheap and easy, now making up about half of all U.S. investments. The simplicity and low cost of passive investing have attracted millions of people, from seasoned investors to complete beginners. By eliminating the need for constant buying and selling, passive funds reduce transaction costs and management fees, making them an attractive option for those looking to maximize their returns over the long term. But here's the catch: the bigger a company gets, the more these funds are forced to buy, making the giants even bigger. This creates a self-reinforcing cycle where the largest companies receive the most investment simply because they are already large. As a result, these companies continue to grow, often at the expense of smaller, potentially more innovative firms. This feedback loop fuels market concentration, regardless of whether those companies are actually good value. It means that a few dominant players can end up controlling a significant portion of the market, which can stifle competition and innovation. Investors may find themselves heavily exposed to a handful of companies, increasing their risk if those companies face difficulties. Passive investors also tend to hold steady, making the market seem more resilient. Because they are not constantly buying and selling, passive investors can help stabilize the market during turbulent times. Their long-term perspective means they are less likely to panic and sell during short-term downturns, which can help prevent market crashes from becoming worse. During the 2020 crash, most didn't panic and sell, helping the market bounce back quickly. This resilience was a testament to the strength of passive investing. While active traders were scrambling to adjust their portfolios, passive investors stayed the course, allowing the market to recover more swiftly than it might have otherwise. But if something truly scary happened, and everyone tried to sell at once, the system could be tested like never before. The stability provided by passive investing relies on the assumption that most investors will remain calm. However, in a severe crisis, if a large number of passive investors decided to sell simultaneously, it could lead to a rapid and severe market downturn. Automatic investing has made the market bigger and steadier, for now. The influx of money into passive funds has contributed to the overall growth and stability of the market. However, this stability is not guaranteed to last forever. The very mechanisms that have made passive investing so successful could also be its downfall if market conditions change dramatically. But it could also make a downturn much worse if the tide suddenly turns. If the market were to experience a significant shock, the mass exodus of passive investors could exacerbate the decline, leading to a more severe and prolonged downturn. The future of automatic investing remains uncertain, and only time will tell how it will shape the financial landscape. The market's towering high, leaning on a few giants, and maybe in a bubble. What could bring it down? The Federal Reserve is key. If inflation returns, they might raise interest rates, making money more expensive and stocks less attractive. That's what triggered a 20% drop in 2022. Trade wars are another risk. New tariffs or global disputes can spook investors and cause sharp drops, like the 12% dip in April 2025. Geopolitical risks, wars or sudden crises can disrupt markets in a flash. A major conflict or supply shock could send prices soaring and businesses scrambling. History shows that unexpected events often trigger market crashes. The market looks strong, but it's vulnerable to shocks from interest rates, trade, or world events. All it takes is one nudge to topple the tower. These are the wild cards that could change everything overnight. Let's look back. Big market crashes happen about once a decade, part of the stock market's natural rhythm. The 1929 crash kicked off the Great Depression after a wild, optimistic run fueled by new technology. In 2000, the dot-com bubble burst when excitement over the internet outpaced reality, wiping out fortunes. Even world-changing tech can't justify impossible prices forever. These stories aren't meant to scare you, but to show that markets have always bounced back. They've survived wars, depressions, and bubbles. Each crash felt like the end, but recovery always followed. The key lesson: crashes are temporary, but long-term growth has been permanent. If you can weather the storm, history says you'll be rewarded. The market's ups and downs are just part of the journey. If a crash happens, how long does it take to recover? There's no set timetable. Sometimes it's quick, sometimes it's a long wait. After the COVID-19 crash in 2020, the market bounced back in just 4 months. But after the dot-com bust, it took over a decade to recover. The 2008 financial crisis took about 4.5 years. That's why financial advisors always stress long-term investing. If you need your money soon, the stock market is risky. But if you're investing for decades, a crash is just a dip in a long journey. Patience is key. History shows those who wait are eventually rewarded. The cleanup after a crash can be fast or slow, but recovery always comes. So, is a crash just around the corner? The truth is nobody knows, not even the experts. The markets run up fast, leaning on a few tech stars with prices looking stretched. Risks are high and all the ingredients for a tumble are there. But people have predicted crashes for years, and the market keeps climbing. The optimists say AI will unleash real growth, and passive investing makes things more stable. Maybe this time is different, but maybe not. The best path is to invest for the long term, stay diversified, and hold on through the scary bits. Crashes come and go, but human ingenuity always wins in the end. Now how about that cup of tea?